Hello, all my dear students. I am Professor Shweta Shrimali from S.V.K.T. College. Today we are going to learn about the Cost and Works Accounting 3 from TYBCom. Thereunder, we are going to study on the chapter the practical examples on marginal costing. This is the recap what we have earlier discussed. We have discussed the practical examples on calculation of BEP, calculation of PV ratio and calculation of margin of safety. We have studied the basic examples related with these three concepts, that is PV ratio, break-even point and margin of safety. In this today's session, we are going to study some more practical examples regarding sales, calculation of desired profits as well as calculation of desired sales, and also regarding the contribution, PV ratio and BEP. So let us start this with an example first. Sunny Limited, Gurgaon has prepared the following budget estimated for the year 1920. So they have given us the following particulars. First, sales of 15,000 units, fixed cost rupees 34,000, sales value rupees 1,50,000, variable cost per unit rupees 6, and you are required to calculate PV ratio, BEP sales and margin of safety, as well as also calculate the effect of the following, which includes decrease of 10% in selling price and second, increase of 10% in variable cost. So we have sales, fixed cost, sales value, variable cost per unit. So let's start the calculation. The first, PV ratio. For calculating the PV ratio, we know the formula, that is contribution per unit upon selling price per unit into 100. So let us put the figures into the formula we will get. So first of all, we have to calculate the selling price per unit, which we don't have in our example. For calculating the selling price per unit, we have the sales value, that is 1,50,000, and we have the sales units, that is 15,000 units. By dividing this value to the units, we can get the selling price per unit, which is rupees 10. So rupees 1,50,000 divided by 15,000 units is equal to rupees 10. Hence, contribution can be calculated by deducting the variable cost from the selling price, which we have in per unit. So we can get the contribution as rupees 10 is the selling price per unit minus rupees 6, which is variable cost per unit, and the contribution is rupees 4. So we can easily calculate the PV ratio, which is contribution per unit, that is just calculated rupees 4 upon just calculated selling price per unit, that is rupees 10 into 100, and the PV ratio that we will get is 40%. Now let us calculate the next is BEP sales. We can also know the formula for calculating BEP sales, which is fixed cost upon PV ratio. And in our example, we have the fixed cost of rupees 34,000 and just calculated PV ratio is 40%. So we can get the BEP sales of rupees 85,000. Thereafter, the next calculation which is required, that is margin of safety, which can be calculated by deducting BEP sales from actual sales. So rupees 1,50,000 minus rupees 85,000, and the margin of safety is rupees 65,000. We have the BEP sales that we have calculated, that is 85,000, and also in our example there is given the actual sales, and in this way we can calculate the margin of safety. Then second part, which is decrease of 10% in selling price. So original selling price is rupees 10 minus decrease of 10%, that is 10 into 10%, it is rupees 1. So the new selling price that we can get is rupees 9. Hence, to calculate the new PV ratio, we can have the formula again, contribution per unit upon selling price per unit into 100. So contribution, again we are required to calculate the new contribution by having a new selling price per unit. So we have the new selling price per unit minus variable cost per unit. Hence, rupees 9 minus rupees 6 and the new contribution will be rupees 3. So, we will put these figures into our formula, that is contribution per unit, that is rupees 3, upon the new calculated selling price per unit, that is rupees 9 into 100. And in this way, the new PV ratio is 33.3333%. The second calculation is the BEP sales, for which we have again the formula, that is fixed cost upon PV ratio, and in our example we have the fixed cost of rupees 34,000 upon PV ratio is 33.3333%. So, the new BEP sales, which can be calculated as rupees 1,02,000. Thereafter, again they have required us to calculate margin of safety, which can be calculated by deducting BEP sales from the actual sales. So, again we have the actual sales of rupees 1,50,000 and just calculated BEP sales, that is rupees 1,02,000, and the new margin of safety is rupees 48,000. Now, second part, they have told us to increase of 10% in variable cost. So, again we have the original variable cost per unit plus increase of 10%. So, original variable cost is rupees 6 plus 10% of 6, that is 0.060, and the new variable cost we get is rupees 6.60. So, we will use this into our formula. So, contribution per unit is equal to selling price per unit minus now new variable cost per unit. But we have the selling price per unit, which we have already calculated in our first example, that is rupees 10 minus the new variable cost per unit, that is rupees 6.60, and we get the contribution per unit, which is rupees 3.40. So, we will put these figures into our formula, that is the PV ratio is equal to contribution per unit upon selling price per unit into 100. So, rupees 3.40 upon rupees 10 into 100, and the new PV ratio is 34%. Likewise, the again BEP sales in value, we have the fixed cost PV ratio. So, rupees 34,000 upon 34% is equal to rupees 1 lakh is our BEP sales. Same way, the margin of safety, again we have the formula actual sales minus BEP sales. So, rupees 1,50,000 minus the just calculated BEP sales, that is rupees 1 lakh, and we will get the margin of safety is rupees 50,000. In this way, we can calculate by having increase or decrease in the selling price as well as in variable cost. Now, let us move forward to the next example. From the following cost data related to Maxwell India Limited, you are required to calculate BEP units as well as sales, and sales required to earn a profit of rupees 54,000. They have given us the selling price per unit rupees 18, contribution per unit rupees 6, and fixed cost is rupees 84,000. So, let us solve it. First, BEP in units. Again, we can use the formula for calculating BEP in units, that is fixed cost upon contribution per unit into 100. So, in our example, we have the fixed cost of rupees 84,000 upon contribution per unit, that is rupees 6, and the new BEP units will be 14,000 units. Then they required us to calculate BEP in sales as well. So, for calculating BEP in sales, we have the formula which is fixed cost upon PV ratio. But we have to calculate the PV ratio. So, the formula for calculating PV ratio is contribution per unit into selling price upon selling price per unit into 100. So, rupees 6 upon rupees 18 into 100, and in this way we will get the PV ratio as 33.3333%. So, we can put these figures into our BEP sales formula. 84,000 is the fixed cost upon PV ratio is 33.3333%, and the BEP sales will be rupees 2,52,000. Then the second example, which is called as sales required to earn a profit of rupees 54,000. So, we have again PV ratio. We can calculate the PV ratio as a contribution per unit, but to calculate the contribution, we can say that again we can use the formula for the same, which is fixed cost plus profit. So fixed cost plus profit is equal to our contribution upon sales. So in our example, we have already have the PV ratio, that is 33.33% is equal to fixed cost, which is rupees 84,000, the desired profit, which is rupees 54,000, and we are required to calculate the sales value. So by cross multiplication, we can calculate as sales is equal to the addition of 84,000 and 54,000 is 1,38,000 upon 33.3333, which is our PV ratio. In this way, we can calculate the sales, that is rupees 4,14,000. Now, this is the example. Jindal Company Limited, Jamnagar provides you with the following cost details. Non-variable cost is rupees 2,000. Variable cost of sales is 60%. Total turnover, that is sales, rupees 10,000. Net margin, which is 2,000, and they required us to calculate BEP in sales. Sales volume to earn a profit of 6,000, and margin of safety when sales are rupees 25,000. So answer is, we have required to calculate the sales variable cost. How we can calculate the variable cost? See, in our example, as variable cost of sales is 60%, then the PV ratio will be 100 minus 60%, that is will be 40%. How we can calculate the profit? We can calculate the profit by deducting variable cost from the sales. So we will assume sales is rupees 100 and we will deduct the variable cost, which is 60%, from this 100%, and in this way we can get the profit as 40%. So the PV ratio is 40%. Then break-even sales. To calculate the break-even sales, we know the formula, which is fixed cost upon PV ratio. So we have the fixed cost of rupees 2,000 and the just calculated PV ratio is 40%. So the break-even sales can be get as rupees 5,000. Thereafter, they also required us to calculate sales volume to earn a profit of rupees 6,000. So the desired profit calculation, where PV ratio is equal to contribution upon sales, but contribution is equal to fixed cost plus profit. So there is a two formula for calculating the contribution. Either you can deduct the variable cost from the sales, or you can add the profit to the fixed cost. So PV ratio is equal to fixed cost upon profit, fixed cost plus profit upon sales. So we have the figures, hence sales is equal to cross multiplication. We can add 2,000 plus 6,000 upon the PV ratio, which is 40%, and the sales we can get as rupees 20,000. Here we have done just the cross multiplication for calculating the sales value. Thereafter, the margin of safety, if sales are 25,000. So the actual sales minus BP sales. Actual sales they have given us rupees 25,000 and the BP sales we have calculated as rupees 5,000, and the margin of safety can be calculated as rupees 20,000. I hope you have understood these calculations regarding desired profits, calculation of sales, calculation of BP, units as well as value, and the PV ratio and margin of safety. This is what about the practice session or learning session which you are required to calculate at your homes. So there is the sales marginal cost, fixed cost, and you are required to calculate PV ratio, break-even sales, and also sales to earn a desired profit of rupees 15,000, and profit when sales amounted to rupees 1,40,000. So sales when there is a given a profit, as well as profit when there is given a sales. And in the coming lecture, we are going to talk on some more practical examples regarding marginal costing. Thank you very much.